In our previous sessions, we've explored liquidity from many angles: regulatory metrics, pricing frameworks, stress testing, and contingency planning. But while those topics often deal with policies, models, and assumptions, liquidity is also a real-time, day-to-day business. At the heart of that business sits the Treasury function. Treasury is where liquidity is watched, managed, moved, and optimized minute by minute, hour by hour. It's the operational core of liquidity risk management. So in this session, we're going to explore what Treasury does, how it operates, and how it fits into the broader risk and finance structure. We'll look at how Treasury manages cash, funding, and liquidity buffers, how it interacts with internal stakeholders and external markets, and what systems and controls it uses to navigate the complexity of modern banking. By the end of this session, you'll have a clear understanding of the Treasury function, not just what it is, but why it's so essential to keeping a bank liquid and resilient. So let's begin with the basic mandate of Treasury. Now, Treasury is responsible for managing the bank's liquidity, funding, capital markets activity, and often its interest rate risk and currency positions. Now, while exact responsibilities vary by institution, Treasury is always the central player when it comes to ensuring the bank has enough cash to meet its obligations in the right currency, at the right time, and in the right place. It serves as both a service provider and a control function, supporting the business lines with funding while safeguarding the institution's liquidity profile. Now, one of Treasury's core responsibilities is liquidity buffer management. Now, this means ensuring that the bank holds an adequate stock of high-quality liquid assets that can be quickly converted into cash to meet short-term obligations. Now, these buffers support regulatory metrics like the liquidity coverage ratio, but they also provide operational flexibility and crisis resilience. Now, Treasury monitors the composition, location, and usability of the buffer on a daily basis. Assets must be unencumbered, correctly classified, and appropriately diversified. The team also considers market conditions, because liquidity is not static, and what's highly liquid today may become harder to sell tomorrow. Now, buffer management involves not only holding the right assets, but also maintaining operational readiness. Now, that includes ensuring that repo facilities are available, counterparties are approved, and collateral can be mobilized efficiently. Now, many Treasury teams maintain monetization ladders or liquidity waterfalls, which are predefined sequences of how assets will be used in a stress event, balancing speed, market impact, and cost. Now, this preparation ensures that the buffer is not just theoretical, but genuinely usable. Another central role of Treasury is cash and intraday liquidity management. Now, every day, banks process vast volumes of payments, customer transactions, security settlements, margin calls, and interbank transfers. Now, Treasury ensures that cash is available where and when it's needed, avoiding payment failures, overdrafts, or reputational risks. Now, this involves forecasting intraday flows, monitoring real-time balances, and coordinating with business units and operations teams. Treasury also manages central bank accounts and access to liquidity facilities. So in many systems, such as the Bank of England's RTGS, which is the real-time gross settlement infrastructure, banks must maintain sufficient balances to meet settlement obligations throughout the day. Now, Treasury ensures that these balances are topped up, collateral is in place, and systems are functioning accordingly. Now, in times of stress, intraday liquidity can become just as important as the end-of-day liquidity, and Treasury must act fast to resolve blockages. Now, when it comes to funding strategy, Treasury plays a strategic and tactical role. Strategically, Treasury plans the bank's funding profile. So how much to raise, in what tenors, in which currencies, and through which instruments. Now, this includes issuing bonds, raising deposits, accessing secured funding like repos or covered bonds, and engaging with wholesale counterparties. Now, Treasury must align funding plans with the asset strategy, regulatory requirements like the NSFR, and market conditions. Now, this planning is typically captured in the bank's annual funding plan, which is reviewed by ALCO and approved by the board. Now, tactically, Treasury executes funding transactions, prices internal and external funding, and manages short-term liquidity flows. On any given day, Treasury may need to raise overnight cash, roll maturing deals, or rebalance funding across currencies. These actions are guided by liquidity forecasts, regulatory targets, market conditions, and internal pricing signals. Speed and precision are essential. The Treasury desk may operate as a central hub with visibility over cash positions across the bank and authority to direct or allocate funding accordingly. Treasury is also responsible for contingency liquidity readiness. Now, this means maintaining access to emergency funding sources such as central bank facilities or backup lines with counterparties. It involves pre-positioning collateral, ensuring legal agreements are in place, and rehearsing operational procedures. Now, in a liquidity crisis, Treasury is on the front line, executing contingency actions, managing liquidity calls, and liaising with regulators and central banks. Another important function of Treasury is its role as the internal bank. Now, through funds transfer pricing, Treasury intermediates between the business units that generate funding and those that use it. It sets internal funding rates, allocates liquidity costs, and manages balance sheet structure. Treasury ensures that funding incentives align with risk appetite and strategy. If the bank wants to lengthen its liability profile, Treasury can do this by increasing the internal cost of short-term funding. If it wants to encourage more retail deposits, it can increase the credit to deposit businesses. Treasury also plays a key role in asset liability management, or ALM for short. Now, this includes managing interest rate risk in the banking book, foreign exchange exposures, and structural mismatches in the balance sheet. In some banks, ALM sits within Treasury. In others, it's a separate but closely linked function. Together, they ensure that the bank remains stable and profitable across interest rate cycles, funding environments, and business growth phases. Now, the interaction between Treasury, risk, and finance is critical. Risk provides oversight, so reviewing Treasury's activities, monitoring limit usage, and challenging assumptions. Finance provides the data, forecasts, and accounting inputs needed for liquidity planning and reporting. Now, the three functions must work together to align liquidity management with strategic and regulatory objectives. Effective Treasury teams are deeply integrated into ALCO, ILAP, stress testing, and recovery planning processes. Externally, Treasury teams interact with a wide range of stakeholders. Now, these include central banks, which provide operational accounts and liquidity facilities, regulators who receive liquidity reports and conduct supervision, investors who buy the bank's debt or equity, and counterparties who provide market funding or transact in derivatives. Treasury must maintain strong relationships, transparent communication, and robust operational infrastructure to manage these interactions effectively. Now, technology is increasingly important to Treasury operations. Modern Treasury functions rely on liquidity dashboards, cash forecasting engines, collateral management platforms, and automated dealing systems. Real-time data is essential for making informed funding decisions, managing risk, and meeting regulatory requirements. As liquidity risk becomes more dynamic and interconnected, technology investment becomes a competitive necessity. Now, Treasury is also at the forefront of regulatory compliance. The team is typically responsible for producing or supporting liquidity reports such as the LCR, NSFR, PRA 110 in the UK, and similar templates in the EU. Now, these reports require detailed, high-frequency data across products, currencies, and legal entities. Treasury must ensure that data is accurate, reconciled, and submitted on time. Errors or late submissions can trigger supervisory action or damage the bank's reputation. Now, operational resilience is another key concern. Treasury must be able to function under stress, whether that's a market crisis, a cyber event, or a systems outage. Many banks now operate Treasury resilience frameworks, including backup sites, remote access protocols, dual authorization systems, and crisis communications plans. Now, these frameworks are tested regularly and reviewed by internal audit and regulators. Now, one challenge Treasury teams face is balancing profitability with safety. Now, Treasury is often expected to manage liquidity prudently while also contributing to the bottom line through interest rate positioning or funding optimization. Now, this requires careful governance, clear mandates, and alignment within risk appetite. Treasury is not a profit center in the traditional sense, but its actions have significant impact on the bank's financial performance. Now, Treasury's role continues to evolve. In recent years, it's become more strategic, supporting growth, capital planning, and even sustainability goals. For example, Treasury may issue green bonds, develop ESG-aligned funding strategies, or support business lines with ESG-linked pricing. As banks respond to new challenges such as climate risk, digital disruption, geopolitical shifts, Treasury is being asked to do more with greater speed and sophistication. To summarize, the Treasury function is the operational engine of liquidity management. It keeps the bank running on a daily basis, ensures compliance with regulatory standards, and acts as the first responder in times of stress. It bridges the gap between funding and strategy, between market conditions and internal decisions. It requires skill, precision, coordination, and resilience. In our next session, we'll explore the market side of liquidity. So how banks raise and deploy funding across instruments, currencies, and counterparties. We'll look at unsecured funding, secured funding, repo markets, and capital market activity, and how these interact with liquidity planning and regulatory expectations. I'll see you in the next session.